Hey, what's up, everyone? It's Jordan Dove, and it's time for this week's Market Pulse, where we discuss housing and economic news for the week of October 24th, 2022. I hope everyone is doing well. I'm so grateful for you guys being here. I hope you could find some of this information useful. If you do find it useful, share it with somebody so that they have their finger on the pulse so that they can make informed decisions for themselves. Okay, I'm not going to give you guys any fluff, no sales BS. If you need an agent, if you're looking in Southern Nevada, if you need an agent across the country, go to my website, jordandove.com. Click on schedule an appointment with me. I'd love to put in a block of 30 minutes and discuss your goals with you. I'm not going to tell you it is a good time to buy or sell property, land, investments if it's not, or it could be. It depends on every scenario, and each situation is completely different. So I'm here to help no matter what you want to do. I'm here to help you enhance your lifestyle through real estate. It's been really good to me and my family. We have made some great investments, we've made some bad investments, and we've learned a lot from those, and we want to help you guys succeed, okay? So, anyways, on today's report, we are going to review what happened last week. We're going to discuss some important economic notes, and then we're going to move into the ever important national housing market update, which a lot of you are here for, so make sure you stay through and watch it. We're also going to do our local market update in Southern Nevada, which includes Clark and Nye County, and we're going to make this week's predictions. We're also going to discuss the Federal Reserve Watch. We're watching them every week, and we're looking at the current Wall Street sentiment on future rate hikes. So let's get right into our review of last week. Last Friday, the traders, they sent the three major indexes to their biggest weekly gain since June on indications the Fed might back off from its aggressive pace of rate hikes this year. And where those indications came from was comments by the San Francisco Fed president and a Wall Street Journal article suggesting the Fed will hike rates by 75 basis points in November, but possibly do a smaller increase in December. A big negative was that the Treasury's report of $430 billion September deficit was up massively from $65 billion just 1 year ago. So that's a huge change. But however, generally better than expected Q3 corporate earnings provided a nice tailwind for the rally. And I think a big reason is we're seeing a lot of the bank and financial stocks. They have been rising, and because people have been spending more money on credit and just spending more money in general with these higher interest rates on these credit cards, they are posting higher returns, higher profits because people are spending more money, the banks make more money. So man, guys, hold on to that money tight. The last week ended up with the Dow up 4.9%, the S&P up 4.7%, and the NASDAQ up 5.2%. And with the investors flocking to surging equities, bond prices fell. The 30-year UMBS 5.5% down 82 cents to $97.27. I have not seen it below 98. That means typically when they're lower, rates and mortgage rates are higher. And in Freddie Mac's primary mortgage market survey, the national average 30-year fixed mortgage rate slowed its rise a little bit, up just 2 basis points. And remember, guys, mortgage rates can be extremely volatile, so check with your mortgage professional for up-to-the-date information. If you are in the market to buy and you're making an offer on a property, undercut the property purchase price. Ask for as much money as you can to buy down that rate and get yourself a good deal, because there's going to be some extremely motivated sellers here soon who are going to need to take what equity they have as they see it deteriorating and the economy deteriorating. They're going to start accepting crazy offers. I'm actually going to send out the playbook on what to do very soon, so make sure you go to my Substack, jordandove.substack.com. Enter your email address. I'm going to be doing this write-up later this week on what the play is going to be, because there's going to be huge opportunities, and I really hope that you guys and my family and my friends and anybody who has that opportunity will take advantage of it, because it just won't be in real estate. There's going to be so many other opportunities. If you've been wanting to buy that off-road RZR, it was $30,000, man, there is going to be fire sales on these things where you can pick them up for 50 cents, 40 cents on the dollar. People are going to be looking to liquidate them. It's going to be a great time if if you are prepared for it. So make sure you go to the Substack. I'm going to give you guys the playbook for the real estate strategy that I'm going to be implementing here soon. I'm going to be advising my clients that this may be a good idea for you. There's going to be a huge opportunity in the near future, in the next year or two, and I hope you guys will take advantage of it. So please go to my Substack. I don't want you to miss this information. It can change your life. So go to jordandove.substack.com. It is time that everyone gets wealthy by trying to take some calculated risks. Okay, so let's go into some economic notes that I feel are important markets to watch. Unemployment. The reports are remaining volatile. The number of people filing for unemployment benefits for the first time fell by 12,000 in the latest week, as 214,000 initial jobless claims were reported. This decline followed increases of 29,000 and 7,000 in the previous 2 weeks' filings. Continuing claims, which measure people who have continued to receive benefits after their first initial claim is filed, rose 21,000 to 1.385 million. And something that I thought was very interesting, I wanted to share. There is a number of major manufacturing indices, including those for the New York and Philadelphia regions, and they have all reported negative numbers, far worse than expectations. In New York, October's Empire State Index was more than twice as bad as anticipated, marking the third straight month in a row below zero, while Philadelphia Fed Index saw a second straight month in negative territory. And this data follows recent headlines out of the Financial Times and Wall Street Journal, which included global economic warning lights are flashing red, risks of a deeper global slump escalate, and economists now expect a recession, job losses by next year. We just saw that there was a Senate committee member that just sent a letter to the Fed saying, hey, you guys need to slow down. We cannot lose jobs. That's going to be really interesting to see what they do at the November 2nd FOMAC meeting. I still think 75 basis points is going to happen. Now, the International Monetary Fund also cut its global growth outlook for 2023, warning that recession risks are rising and the worst is yet to come for the global economy. And that's nothing like Frank Sinatra's "The Best Is Yet to Come." The Fed's latest Beige Book, which is a summary of commentary on current economic conditions, also featured the word recession a record high 13 times. And guys, if you've been doing this a while, I don't do as many videos as I should, but Chuck Barone does a daily show, Greg Manarino does a daily show, and we have been saying that this recession is here months and months and months ago. And now you're finally getting the mainstream saying, oh crap, it's coming, because it's already here, guys. It's already happening. So hold on, fasten your seatbelts, enjoy the ride, and take advantage of those opportunities that are coming. Let's talk about the Treasury bond yields. The 30, 10, 5, and 2 all rose, but the 30-year surpassed the 10-year, so it means that those two yields are not inverted at the moment. The 10-year is sitting at 4.36. The 30-year is sitting at 4.36. The 10 at 4.215. The 5-year is sitting at 4.341%, and the 2-year at 4.503% as of Monday, October 24th. Now it's time for your favorite part, the national market housing update, and sorry, it's not very good. Existing home sales dipped 1.5% in September. That's down for the 8th month in a row, their longest losing streak since 2007, but the last 2 months posted the smallest declines this year, so sales may be stabilizing. Please let us hope so. However, sales were down 23.8% when compared to September of last year, and this is critical information for taking the pulse of the housing market as it measures closings on existing homes, which represent around 90% of the entire housing market. Now, on a national level, the number of available homes declined for the second month in a row, down 1.8 million at the end of August to 1.25 million at the end of September. This equates to a 3.2 month supply of homes. But wait, there's more. There were only 732,000 active listings in September, which means that 41% of the inventory in the existing home sales report is actually under contract and at this time not truly available. So this speaks to demand, as a normal market has 25% of inventory under contract. When looking at the month supply of homes, it's actually really 1.9 months in on the national level. However, the Northeast and the Midwest part of the country, they're still seeing a hot housing market because there's a lot of pockets where housing is affordable and can still be affordable with these higher interest rates. So that these are propping up the national numbers in areas in the Northeast and the Midwest. However, areas in the West, the Southwest, the South, we're seeing massive rises of inventory and price decreases. So in one area of the country, you have hot. Another area of the country, you have cold, and they're kind of balancing out, giving this balancing act out. So let's see what happens. Let's move into housing starts. And after we had a rebound in August, housing starts resumed their path downward in September, off 8.1%. But good news came with building permits up 1.4%, though this was all due to the multi-unit sector. Builders are looking to building multifamilies, apartments, because they can be more affordable. People can afford these things, and they can also build more on less land, so they will see a better return. So look for more multifamily living coming in your area. Now, builders are cautious about single-family home demand because of the higher mortgage rates. The National Association of Homebuilder Sentiment Index is at 38, and that is the lowest level in 10 years. Below a number of 50 in this index means that more builders see conditions as poor versus good. And a little did you know, even though existing home sales were down in September, demand did stay up. Buyers' urgency was relatively high. That 70% of homes were on the market less than a month. That is historically pretty good. However, these properties that closed in September are from accepted contracts in July and August. And if you guys will remember, we had that dip in rates at the end of July where they were mid to high fives. I think some people took advantage of that. Now we were seeing those closings throughout the month of September. Okay, so keep that in mind. Now, welcome to fabulous Las Vegas. So I don't have my Vegas background today. Something with the audio, it was being a little funky. So let's get into our Southern Nevada, Las Vegas, Nevada, a boomer bust town, and not only in the casinos, but our housing absolutely soared the past 2.5 years during an unexpected pandemic, and the absorption rate has finally dipped below 20% for the first time in over 2 years. Go back to the previous videos and market reports, said it was going to happen any week for the last couple months, and here it is. The current absorption rate is 19.97%, which is down 1.25% from last week's reading. That's a big dip. This is the first time since before the pandemic that the absorption rate figure, or the ARF, has dipped below the 20% mark. This marks 3 consecutive weeks of a decline and a decrease in 11 of my last 13 readings. Now, a market with an absorption rate above 20% is typically called a seller's market, whereas an absorption rate below 15% signals a buyer's market. So we have moved into that 5% range of an even buyer's and seller's market. Still shifted towards the sellers, but we are seeing those reductions in prices coming down. And I think we will continue to see this number decrease. I do believe we will see this number close to 15% sometime in the middle of 2023. Now, each week I update you guys with the current median price for the current month. Please keep in mind that the majority of sales occur at the end of the month, so the official median price numbers will be published on the first Monday of each month on the Market Pulse update, which you are here today. And if you like this kind of information, please subscribe, like the video, leave a comment about what you think. I would appreciate it. Share this video with someone who might find this information useful. All right. So, tracking current median prices for October 2022, which we check every Monday, and we give those final median prices out in the first episode of the month for the preceding month. Single-family homes are showing as down $10,000 from September to $440,000. That's down from its May peak of $482,000, meaning half the homes sell above this price, half sell below. Here's our median. We could break it down in different price ranges, but that's really not the statistic we're looking at to read the trend line. But that means from that May peak to September, we have seen an 8.7% price correction on single family homes since that May peak, and I still think we have a ways to go due to interest rates above 7% and homes coming back down to be more affordable at those rates. Condominiums are down $4,000 from September to $226,000, but surprisingly, townhomes are up $5,000 from September to $325,000. This week showed a slight decline in inventory, and this week marks the second time in 4 weeks that inventory shows a week-over-week decline. However, the past 29 to 31 weeks have seen an increase of available inventory, but I do believe we're flattening out around that 11,000 to 11,500 level of available inventory as we move into the fall selling season. Now, rentals are increasing on the market as fears of sellers and many homeowners and investors are opting to rent their property versus selling because they weren't getting what they wanted. So they're not going to keep their homes on the market, keep taking a hit covering costs. So they've opted to put those properties on the market. But now rentals are sitting on the market longer and prices of rentals are starting to come down a little bit. So good news for renters. There are currently 11,344 properties on the market, which is 83 less than 1 week ago. Currently, there are 8,575 single-family homes without an offer on the market, 1,130 condos, 780 townhomes, 314 manufactured homes, 448 high-rise units, 93 multiple dwellings, and for land, we have 2,697 parcels of land and 3,590 rentals on the market. This past week in our market, we saw 1,657 price decreases. We were seeing 1,800, 1,900, 2,000 per month, but that is coming down. 740 properties accepted a contingent offer and 617 closed and recorded. 587 properties were taken off the market either temporarily or permanently. And that is the market update for Southern Nevada. If you guys have any questions, leave them in the comments. Now, our predictions for the week are home sales and consumer sentiment will be down and inflation will be up. We expect continued contraction for September new home sales and the pending home sales index of contracts on existing homes. The final read on the University of Michigan consumer sentiment for October should be down too, languishing at historic lows. Unfortunately, forecasts are to be up for PCE prices, and that is the Fed's favorite inflation measure. Now, watching our friends over at the Fed, at the Federal Reserve, who will probably end up getting blamed for all this when it's said and done by the politicians in Washington, D.C., because have you ever heard of a politician taking blame for something? They always want to point a finger and blame somebody else. So they're going to blame the Fed instead of their own policies. And the futures market is seeing a 0.75% rate hike in November, but then 0.5% hike in December and February. There is a 92.2% consensus that the Fed will raise rates next Wednesday, 75 basis points, moving the current Fed rate to 3.75 to 4%. All right. So that's the market pulse update for October 24th, 2022. Hope everyone's doing well. Remember, I'm going to lay out the strategy. I'm going to give you guys the playbook on what I will be doing and advising my clients to do later this week. So go to jordandove.substack.com. Make sure you guys are signed up. Check that email. It is going to be the way to change your life in the future, and you will have some time to prepare for it, okay? So get prepared. You're going to have a couple years. I'm going to give you the playbook, and let's make it happen for you and ourselves and everyone who's willing to put in the work and take a calculated risk. All right? Until next time, love you guys. Take care and be well.